Hi, and welcome to the Family Office Sherpa podcast. I'm your host, Shaun Parkin, founder and managing director of Whole Road Investments. The aim of this podcast is to provide practical and implementable advice for those looking to build, manage, or service a family office. This is not investment advice, so please check the disclaimer in the show notes. In this episode, we are covering the use of exchange-traded funds, or ETFs, by family offices. We're also going to dig into some of the new detail from two recent family office reports from Citi and UBS, and note a couple of new businesses started by Andrew Hager in Australia and Edward Marshall in New York.
This is the Family Office Sherpa.
First off, ETFs is a tool for family office investments. Now, my first role at SSGA was head of institutional clients or institutional asset owners for the exchange-traded fund business, which was great. At the time, this meant a lot of meetings speaking to asset owners that really either didn't see the merit or maybe didn't see the underlying benefits of the structure of an exchange-traded fund for portfolio management, for all the other aspects that they might be using, direct investments or futures or something like that. This contrasted, however, with my conversations with family offices, which was actually a really pleasant surprise. So at the beginning, family offices were a big part of my distribution because they, immediately understood it, and also because of the lower ticket sizes or the subscale nature of exchange-traded funds meant that they could get a lot more access to a lot more markets than they initially thought. It wasn't just the Australian ones. It was US, so the 40 Act funds out of the States, and the UCITS funds out of the European platform, as well as some of the Asian funds. So a really broad spectrum of investments that the family office clients were using. So what were they using them for? So there were four main sort of reasons, or five main reasons actually. One, portfolio completion. Two, tactical asset allocation. Three, equitization, and for the sort of instant multi-asset portfolio nature of exchange-traded funds, and five, to use as sort of an investable benchmark or a core component of the portfolio that they could measure against active managers. So let's go through number one, portfolio completion. When I say that, I think most people sort of understand it, but really what it is it fills gaps in asset allocation. So for those looking to add sort of smaller allocations, smaller weightings to specific asset classes or sectors or geographic regions or something like that, ETFs have been particularly useful when targeting these exposures for particular reasons, right? So it might be emerging markets, commodities, more alternative investments, or those investments that might not be as easily implemented, or they don't particularly want to engage a manager, or they don't want to go through the onboarding process or something like that. They say, this is our portfolio. It's relatively broad in sort of strategic asset allocation, but there's these sleeves, or they're these smaller components of the portfolio that we would like to be able to do hyper efficiently, and we can do that on exchange. So we don't have to, like you said, engage the manager. We click buy. And, that's the sort of thing that we use for portfolio completion. Number two, tactical asset allocation. And I'm sure most people have heard of strategic and tactical asset allocation. Some people, dynamic asset allocation to a certain extent. Plenty of asset owners use ETFs for tactical asset allocation. Let's call it TAA for short. Because one of the challenges is that tactical movements of the portfolio can be short-term. They can be opportunistic, and that's not really that conducive to, again, engaging another asset manager or incumbent asset manager and saying, well, what strategies do you have? What are we looking for? We're talking about passive or indexing here. So really what we're looking for is this opportunity, or this asset class has become attractive to the office. How do we implement it? And for TAA, ETFs are quite a good version of, a good way to be efficient in that allocation for short-term bets or for quick opportunistic allocations. As an example, let's say the equity markets fall significantly. We just want to market exposure or we want, large cap, mid cap, small cap, something like that on the equity side. Use an ETF for that allocation. We're not as concerned potentially with the fee structure because it's very short term. We've got to look at costs of transactions, obviously, because there's brokerage involved. But, for a shorter term, high impact kind of allocation, then ETFs can make a really good implementation method. Equitization. So when I say equitization, some people have different sort of terminology, but it's more of an institutional kind of thing where moving from one manager to another and you're reducing the amount of time you're out of the market. So what we used to see prior to sort of ETFs becoming increasingly liquid and understood is that people would go out of one manager, and to maintain market exposure they might use futures or swaps or something like that. You can use ETFs for that function. They do have some benefits. Some of those benefits being from where they sit on the account side of it. So they sit on the capital account as opposed to the revenue account. They also, some of the very large ones, so let's use like an S&P 500 or some of the big funds that track that, can be really, really low tracking error. And also, let's use the S&P 500 again. Price impact is very, very low. Market impact for trades is very, very low. It's half a penny spread on some of those really, really big ETFs out of the US in particular. So spread costs can be low, tracking error can be lower, depending on which ETF you've got and which part of it. So obviously do your own research there. But they can be quite a good tool for that equitization or that staying in market whilst moving to another manager. So the other one as well is we tend to use them more and more in the family office side these days, which is, multi-asset portfolio. So there are now ETFs that combine, well, not now, but they've been around for a while, but they combine all the asset classes into one unit trust and using underlying index funds a lot of the time, get those multi-asset class portfolios in one unit. So you're just buying the entire thing. They do all the trading for you. They do the rebalancing. You don't have to worry about drift and things like that. If you're doing sort of separate asset class implementation, they're often risk profile based. So if your office has a balanced or growth or something like that, you can use an ETF that matches up that risk profile. But always, as always, just look at the underlying constituents and see what you're actually getting exposure to. Don't just take the name on the tin. And, they're very helpful for those looking for what you call maybe potentially a core exposure. And then you can go do an Explorer or Satellite, which is, higher fee potentially, so you can spend more of your fee budget, lower correlated asset classes, those asset classes that might have higher dispersion, things like that. And you can budget a lot of the fee structure to those more impactful satellite stuff and keep the lower fee indexing as the core weights. And so we do see that quite a bit. The other thing as well was number 5, which is the investable benchmark. Beat the balance fund or something like that. Have some version of, and we talked about it in the previous podcast around sort of benchmarking. It's a great investable benchmark using an exchange traded fund that would be, let's take all the skill set of an active manager, or we're taking away the trading and the rebalancing and the complexity of managing a multi-asset class benchmark portfolio, and using an investable version of it. We can use it as a really good, this is what a simpler, lower cost version of what we're doing looks like. So, that can be very, very helpful. So hopefully that was interesting. I find it interesting. Like I said, I used to love talking to family office clients when I was an institutional head of institutional markets for the ETF business, because they were already using them. They didn't require a significant amount of intermediation and things like that. They could just buy and sell them, and they use them quite effectively, and they continue to do so. So when I see portfolios and family offices, quite a significant amount of them have an exchange traded fund of some sort in there. It might be the large cap weighted benchmarks, or it may be, like I said, that multi-asset class instant balance fund kind of thing. So a lot of education out there from the ETF managers themselves. If you're in Australia, you can download the Excel spreadsheet, which I use quite a lot, which is on the ASX website. I'll use that. I'll put that in the show notes because it's actually a really good resource, and that includes all sorts of cool things like the fees, the naming conventions, because is it an ETF? Because if it's an ETF, it has to be passive. Things like the spread, the cost, the volume. It's a spreadsheet that we used to look at every month when I was on the ETF desk and sort of go, well, who was getting the inflow and who's getting the outflow? So it's actually a really good report. So get onto that. I'll put it in the show notes. And just finally, I'm just starting to put together a little bit of a, what happened in the last fortnight kind of thing. We'll call it the week's roundup or something similar. So 2 reports came out of interest for me. One being the Citi's 2024 Family Office Report. And again, I'll link it in the show notes. Some really interesting stuff. Sometimes I get asked around leverage. And on page 43 of this report, they actually go into how much leverage is used by family offices. It's low, as you'd probably expect with people with large assets that we're not looking to. There's not generally any outflow and things like that. But it is getting more and more into the larger offices. So on page 43 of the report, have a look at it because it's quite interesting to sort of see, who's using leverage and who's not. Another bit of a statistic I liked, which is that 75% of the offices continue to engage and increase the engagement in direct investments. So for those people wondering, well, are family offices still buying into businesses and things like that? Look to page 65 and you'll see some really good data sets for you there. For me, excitingly, investment governance gets its own section from page 69. It's great. There's a lot of really good detail in there around sort of investment committee work and things like that. And the other part is around sort of the challenges. And the main challenges seem to be relative to the size. So importantly from this report, they do this element of $500 million above and $500 million and below. So, and there's a lot of similarities, but attracting and retaining talent seems a more frequent issue among those with more than $500 million. I guess because, like it says, there's more staff, there's more positions to fill. However, conversely, family offices with less than $500 million express greater concerns about managing costs than their larger counterparties. And it kind of makes sense, but I think that's potentially a good inflection, or a good point to make around what's the concern. So if you're a big office, you're looking, staffing is a challenge because staffing is a challenge generally. But if you've got the more sort of unusual, niche kind of family office side, it becomes even harder. And plus, like it says, there's more positions to fill in it. For smaller offices, managing those costs can be quite high because you don't get access. There's that element of you're not getting access to scale. So it depends on how you class costs too. If you're doing it at the basis point level or you're doing it on a total cost point of view. But I think that's an interesting one. Sub 500 mil are outsourcing most services, and if they're not outsourcing, then they're just not offering them. So it gives you an idea around sort of if you're looking at that outsourcing model, then that sub $500 million level is almost getting up to that fully outsourced piece. Family education is provided by 73% to the this is on page 76, which I think is an interesting thing. However, only 22% cited transition managers, so managing the assets moving from one generation to the other, as the role of the family office, which I thought was interesting. And also, disappointingly, only 15% is citing education or educator as a function within the family office. So I'd love to see those 2 numbers tick up. The other one as well is, if you listen to my previous podcast on benchmarking, measuring the family office is a great section within this. It's on page 100. And investment benchmark are what we're really looking at here. But that's a really good report from Citi. They do it every year. It's one of the good ones. And if you're interested in the investment side as well, they've got a lot of detail on asset allocation and where they're investing and things like that. But from myself, who's someone that's incredibly concerned with the investment governance and segmentation of this sector, then I think those points are really interesting. Now, UBS has their quarterly. UBS has been putting out some really cool content lately, which I really appreciate. They do a quarterly report. This one thing they do really, really well is they take information outside of UBS. So they get specialists to provide content, which I think is excellent. So it kind of creates this more well-rounded rather than, oh, this is our particular product or something like that. It tends to be a little bit more well-rounded. And they talk around compensation types, which I thought was really interesting because they do get asked a lot around that. So obviously outside of normal pay plus, some sort of performance bonus relative to, the KPIs that are set, it's the way that they articulate these two elements of carried interest, or carry as it's called, and co-investment. So those two compensation methods are really nicely articulated in that report. So I would recommend, if you're interested in sort of those more unusual or idiosyncratic payment structures within family offices, then check out UBS's third quarter report, which again, I'll put in the show notes. Now, excitingly, as I mentioned, two new firms from two people that are very well established in the family office sector. So Ed Marshall has hard launched his risk management firm called Presage Global. Ed is one of my go-to experts on all things family office, so this is really exciting. I looked at the LinkedIn profile for the firm. That Presage is Presage. The LinkedIn profile says it's a firm that helps clients to proactively reduce risks and make well-informed decisions, which sounds great. And like I said, Ed knows the space incredibly well. There's a significant amount of services that they do, so check out the website. And also in Australia, Andrew Hager, Stephen Daly and Alexander Nikov have launched a new advice business called Famille. Now, if you're wondering how that's spelled, it's Famille. They've all got a history of working within the family office space, in particular the Forest Family Office here in Perth. And so, the insights and challenges and opportunities, let's face it, should be well known by this group. From an article I read, this is how they articulated what they're offering. They're looking to help family offices seek out deals as well as marry up buyers and sellers of stakes in private companies and assist families who wish to sell assets. It'll also offer consulting on succession planning and other thorny issues for the ultra wealthy. So again, the family office space is starting to really develop in terms of the family office services. Also, selfishly, it's great to see a firm open a Perth office, which doesn't always happen, and Perth continuing to punch above its weight there. Yeah, so that's it. Just slight change in sort of the format. Hopefully it works. It's really around sort of trying to make it a little bit dynamic as well as having some evergreen functions within it. That's it for the episode. Hopefully it was of interest as always. If it was, make sure you click the little bell alert thing so you know when the next one's out. Obviously, they come out every 2 weeks. If you want to forward it on, please do. If you're looking for me, you can find me on LinkedIn. I'm relatively active on that. Or feel free to email me, Shaun, so SHAUN, at hallroad, that's HALLROAD.com.au. And if you're interested in the newsletter that we also have, you can find that at hallroad.com.au. Super easy to register there. Until next time, thanks very much.